All right, good um, morning and welcome to our session today. All right, the session for today and next week will be mixed. And for next week, it might even be long, I think. It might even be a longer session. It might be a longer, in fact, it is going to be a longer session, 3 to 4 hours. So we should be prepared for that. And if you are doing FAC again, it will also be longer. So you have to brace yourself for longer sessions as we try to push up. Right. Let me just close some applications here. Right. I'll start from this one has got 4 questions. I think I don't know what we're going to do up to 1 o'clock. Then we'll move on to the whatever we will do up to 1 o'clock. And the other ones will be homework, whatever is remaining. Right. Alpina Limited Alpina is a manufacturer of climbing equipment. Alpina is a small business corporation as defined in the Income Tax Act. The company is a registered value-added tax vendor, and all amounts exclude VAT unless otherwise stated. Alpina is a March year-end, right? There are 2 things that we know about small business corporations. Number 1, we know that small business corporations will have a tax relief, one in the form of Section 12E allowances, which they can have accelerated allowances that are different from other companies. Number 2, they also have a relief in the form of their own tax tables, which are different from those of other companies. So those are the 2 things that we should have there. So we should remember that they qualify for Section 12E allowance. This company qualifies for Section 12E allowance. Right, the company is a registered value-added tax vendor, and all amounts exclude VAT unless otherwise stated. So the amounts that we're dealing with, they do not have VAT. But where stated, we should remember that there is what? There is VAT. So we should take into account the take out the VAT. If a company is VAT vendor, its cost should exclude VAT because they will recover the VAT from SARS, and its earnings should exclude VAT because the VAT will be paid over to SARS. So we should remember that when we are dealing with small business corporation, right? Then, in fact, with a VAT vendor, not only a small business corporation, right? Alpina is a March year end, right? Your year end is very important because there can be some other transactions that may depend on dates. So it is very important that we know our year end. We might have transactions that rely on dates, right? Then we were told to, let's go to what we are required to do. Calculate the taxable liability or refund of Alpina for the 2022 year of assessment, right? So we need the taxable liability. The taxable liability, this is when your tax obligation is more than the provisional tax that we have already paid. Your tax, so if the tax that we're going to get is more than the provisional tax, if any, then we know that there's a tax liability. But if the tax obligations are less than the provisional tax already made, then there can be a refund. So that's where the refund or liability comes from. Right. So right. Right. Let's go at the beginning of the question. Right. Alpina the following income and expenses during the 22-year of assessment. Income, we have sales of 4.1 million. Right. Since there's nothing there, we can then include them as is. For sales. But if there's a note, you first read the note because there might be adjustments that can be required. Right. Then we have foreign interest received on foreign investment. There's nothing else given, so we assume that it is taxable. Then foreign dividends received, shareholding less than 10%, 22,900. Right. Right. If shareholding is 10% or more, the whole amount would be exempt. That means the whole amount, the whole dividend would be exempt. When we say it's exempt, it's part of the income, but it will not be taxed. But in this case, the shareholding, if you can see here, they said that the shareholding is less than 10%. So if the shareholding is less than 10%, then this dividend will not qualify for the full exemption. Right. So then, but we also have what we call a partial exemption. Partial exemption, right? If a foreign dividend does not qualify for any other exemptions, of course, there are other types of exemptions other than the 10% or more. There are other exemptions that are granted to for certain investments, but I'm not going into detail into those today, right? But if a foreign dividend does not qualify for any other exemptions, then we have what we call a partial exemption. We have what we call a partial exemption. This partial exemption depends on the type of taxpayer. This partial exemption depends on the type of taxpayer. Right. If it's an individual, I think this one we're going to do it again after the test in detail, the income and the expenses of individuals. Right. So if it's an individual or natural person, 25/45 of the dividend will be exempt. Right. Then any other person other than natural person. Remember that we've got artificial persons, so don't be surprised with that. That will be 8/28. Like in this case, this is a company, it's not a natural person, so it will be 8/28. Then insurers, 10/30. Right. So in this case, so we're going to have our dividend 22,900. I can say dividend 22,900. Partial exemption 22,900 multiplied by 8/28. What do we get? 6,543. Thank you. That means of this dividend, 6,543 will not be taxed. That's what we mean when you say an exemption. So only 16 will be included in the taxable income. So you have to check the shareholding. And you should note that when we are counting, when we are determining the 10%, it also includes investments that the company has and its subsidiaries. Let's say it is subsidiaries. So that means that 10% when we are determining it, that will include what the company has plus what the subsidiaries have, all in all. Right. Any questions? Sorry, guys, remember that whatever you'll be writing your test will not be necessarily this question. That's why when I answer, I try to also give you other things so that if you meet that and then you find that it's more than 10%, you won't just say 8/28. Right. So that's why we go offside and talk about other things that affect that particular income. Right. No questions. Okay, for the sake of time, okay, then when I send the document, I'll then put those sections so that you can be able to see them. Right.
Eugene.
Mokwena.
Yes, please. I missed the point when you said when the company owns more than 10%, what goes on there? Can you please just
The full
repeat
amount
that?
will be exempt. There will be a full
Okay.
exemption of 22,900.
Okay, thank you very much.
Any other questions? Right. Let's go to expenses. Provision for doubtful debts. There is note number one. Whenever there's a note, don't answer without reading the accompanying note. First, go to the accompanying note and understand what they are saying. But generally, we know that when we are dealing with the allowance for credit losses, we don't just take the provision that is determined by accounting. Right. So it depends when it comes to the allowance. We don't just take the one that is determined according to accounting. It will depend on whether the company is using IFRS 9 or not when determining the impairment. That is what will determine how the allowance that will be granted by SARS will be. Right. If the company is not applying IFRS 9, right. If company is not applying IFRS 9, the allowance will be 40% for debts owing for 120 days or more. Right. Then 25% for debts owing for more than 60 days, but less than 120 days. Right. Then that means there's nothing for, if the days are less than 60 days, there's no allowance that will be granted. Right. If company is applying IFRS 9, 40% of the lifetime credit losses, and 25% of any other impairment. Right. So that means whenever we are dealing with the provision, check if they are applying IFRS 9 or not. I think if you check questions that were set from 2020 going forward, they always specify whether IFRS 9 is applied or not. Right. Now we see here, if they don't tell you, but they give you the days owing, then you know that you just use the days. Now we're told that Alpina recognizes a provision for doubtful debts at each financial year end. Trade receivables do not have a significant financing component, and all trade debtors are due within 1 year. The accounts receivable balance is made up as follows. Based on lifetime expected credit losses in terms of the simplified approach, you may assume that the credit losses have been correctly calculated in terms of IFRS 9. That means this company is applying IFRS 9. So if they are applying IFRS 9, and if the debts are based on lifetime expected credit losses, then we should use 40%. So I've determined that I should use 40% because of two things. Number one, they're applying IFRS 9. And these allowances are based on lifetime expected credit losses. So I know that I should apply 40%. Right. We have got, I think those who are doing FAC, I think are going to do it today in the afternoon. We have got lifetime expected credit losses, and we can also have expected credit losses within a year. Those are two different things. Lifetime, that means throughout the lifespan of the debt, even if it exceeds a year. Whereas within 1 year, we're saying the probability of losing within the next year only. So if there are lifetime expected credit losses and the entity is applying IFRS 9, we use 40%. And the allowance for credit losses for last year is added back, whilst the allowance for credit losses for this year is subtracted. We subtract the allowance for credit losses for this year and add back the one for last year. So we're going to say allowance for credit losses (2021). Since they're using lifetime, we'd use our 40%, multiplied by 20,000. So I've taken my 40% here and multiplied by the allowance for 2021. You multiply by the allowance, not the debtors themselves, the allowance, which is 20,000. Right. So 40% of that 20,000, I get 8,000. I will have to add it back. The one for last year, you add back. Then allowance.
Sorry, sir, isn't for 2021 14,000?
Okay. I think I made a mistake there. 2021, it's 20,000, 14,000, right? Then 2022, it's 20,000. Thank you so much. So can you please correct? I think this one is the one that is 8,000. Can you please correct for me the first one? What we get there? Is it 5.6? Can you verify, please? Thank you. Right. Is that fine? Right. Then, so that means for last year, remember you add, for this year you subtract. Alternatively, you can just say subtract. You can just say 20 minus 14, 6,000 multiplied by 40%, which is 2.4, and then just subtract 2.4. Just finding the difference between the two allowances, and then you multiply by 40%. That can also be an acceptable approach. But to avoid complications, you can just add the one for last year and subtract the one for this year separately. So always when you deal with an allowance, please check for these things prior to adjusting for allowance for credit losses. Right. Then next, depreciation. Number 2. Remember, we don't subtract depreciation. Depreciation is determined using accounting policies. And accounting policies may be different to the approach that is being followed by SARS. So as such, we don't necessarily subtract a depreciation. We have to go and check our assets and see what SAS says in terms of the capital allowances that are granted. And let's remember that in this particular case, we are dealing with a small business corporation. Right. So let's go to number 2. Want to determine our capital. We have these assets here. Right, our buildings, that's the normal 55%. Of course, subject to those things like if you buy an improvement, whereby we use that 55%, the 30%, it's still the same. I'm not going to go into those complications. So whatever we do for buildings for a normal company is the same when it comes to a small business corporation. So the approach when we buy part of a building, part of an improvement, those 55%, 25% small business units, exactly what we do for normal company. That's what we do also for a small business company. There's no difference. But we also have what we call Section 12E allowances that are special for small business corporation. These are only for SBCs. Right. It's 100% on manufacturing equipment. Whether new or second hand. Remember, for a company which is not a small business corporation, it will be 40, 20, 20, 20 if it was acquired new. And it will be 20% per year if it was acquired second hand. That is, we apply Section 12C. But for a small business corporation, whether it was acquired new or second hand, there's no difference. It will just be 100% in the year of acquisition, or in the year that it is brought into use. Right. Then 50%, 30%, 20% for other assets. When we say 50, 30, 20 rule, we mean 50% will be provided in the first year, 30% in the second year, and then 20% in the third year. That's the 50, 30, 20 rule. Right. So now we go to our assets. We have got the following expenses relating to the company's assets were incurred. We have got a new delivery vehicle, including VAT, 310,000. The delivery vehicle was brought into use on the date of purchase. Right. The manufacturing equipment was imported. Okay, before I go to the delivery vehicle. Right. If we are dealing with a small business corporation, my friends, you ignore the binding general ruling. We don't use the binding general ruling. It's an election, actually. But for our exams, as long as it's a small business corporation, we don't use the binding general ruling. Because our assumption is that every company would like to get tax benefits as early as possible. Right. So that means we ignore that. So the only information that we have on the delivery vehicle is this one here. Right. Number 1, we have to take out the VAT because the amount includes VAT. So it's not 310,000. It will be 310,000 times 100 over 115. That will be the cost. Then number 2, on the delivery vehicle, we apply the 50, 30, 20 rule. So we have to check, are we in the first year, second year, or third year? Or fourth year, fifth year? So our year is ending in 22. And we know that it ends in March. And this was acquired on 1 June 2021. So we are in the first year. We are in the first year. The year that ends in March 2022, it means it started in April 2021. And 1 June 2021 falls between 1 April 2021 and 31 March 2022. So it's in the first year. So because we are in the first year, we apply the 50%. Right. So Jeff, delivery vehicle, section 12B allowance, would say 310,000 times 100 over 115. Here we want to take out the VAT. We want the cost excluding VAT. Then multiply by what? 50%. What do you get? Thank you. 134,783. That will be deduction. My friends, if it was not a small business corporation, we're going to use these 4 years. And we're going to apportion June until March. That would have been 10 months. So we're going to say 310,000 times 100 over 115. So the VAT will still take out, then divide by 4 times 10 over 12. Section 12E allowances are not apportioned. Section 12E allowances are not apportioned. But if it was not, if we're using the binding general ruling, we're going to apportion. 12C, 12E are not apportioned. No apportionment. Right. Then manufacturing equipment. 1 August 2021. Let's go and read. The manufacturing equipment was imported from France on 1 August 2021, FOB transaction date for 45,000 euros. Right. If an asset is transported FOB, we translate its cost using the spot rate on the date that it was shipped, on the shipping date. That's the transaction date. So the machine arrived on 1 February. On clearing the machine through customs, Alpine was required to pay import duties of 110,000. Payment for the machine must be made in full on 1 July 2022. Right, our year is ending in March, but payment is to be done in July. The machine was brought into use on 15 February 2022. The relevant exchange rates were as follows. Right, this is in manufacturing equipment. As long as it's manufacturing equipment in an approved process of manufacturing, if you're a small business corporation, you'll be entitled to 100% deduction in the year of that the asset is brought into use. So considering that this asset was brought into use on 15 February 2022, which is during the year, it's going to qualify for 100% deduction. So we're going to have 100% deduction. Right. Number one, the cost should be translated using the shipping date. So we assume that the shipping date was 1 August. So we'll translate at 69. And any other additional costs like transport, insurance, installation, should be added to the cost of the asset. So also add these import duties of 110,000. Right. So we'd say manufacturing equipment, section 12E, allowance, and it will be 100%. Purchase price would say 45,000 times exchange rate on transaction date, which is 1690. What do we get? Thank you. So 65,000. Then import duties. $100,000. So that full amount will be deductible in the first year. But if it was a company other than a small business corporation, we're going to check, was it purchased new or second hand? If it's new, we're going to apply 40% in the first year, not a portion. If it was second hand, we're going to apply 20%. Right. Then number two, if the amount is not yet paid, or if it is paid later than the transaction date, on payment date or at year end, we have to recognize foreign exchange gains or foreign exchange losses. Right. So now at year end, so just like what we do in accounting, at year end, we have not yet paid. Remember that the payment will only be made on 1 July 2022. So we're still owing the 45,000 pounds. But by year end in March, it's now 16.95. The rand has deteriorated from 1690 to 1695. So there is a foreign exchange loss because our debt has gone up. So that foreign exchange loss will have to be, we can be permitted to have a deduction of that. So we have a foreign exchange loss. And you should remember that if we were the ones owed, it was going to be a gain. So that is 45,000 multiplied by the difference between the exchange rates at year end and the exchange rates when we acquired the asset. Right. What do we get?
$2,250.
Thank you. Right. If the rand had gained, that is if our exchange rate had been below the 1690 level, then it was going to be a gain, which we're going to add. And remember, these interpretations, they depend on whether you are owed or you are owing. And mind you, this amount does not affect the value of the asset. It is affecting your payable. Your payable, the asset is already done. It's about the payable. Your payable has gone up. Right. Then for interest sake, not for this question. Remember, our year is ending in March. On 1 July, when this payment is done, they will also recognize the loss from 1695 to 1780. So in the next financial year, there will be another loss that will be recognized. For the movement from 1695 to 1780. But it falls outside our current financial year, so I'm not going to talk about it. All right. Any questions? Right. So that's it on that one. Then we don't also use the general binding ruling because the section 12E is advantageous to the company. Right. Then on the same note, number 2, we're told that on 1 May 2021, Alpina sold an administration building for 1,047,000. The administration building was purchased new on it was purchased new on 1 June 2015 for 890 and was brought into use on the same date. All right. So at the end of the day, we have issues regarding capital gains there. There will be issues regarding our capital gains since it was sold at an amount that is above base cost. Right. Now remember, when it comes to buildings, we have got right, let me just come here. I think I stated that for buildings, normally our assets, we have got that 5% that we normally calculate on the buildings as building allowance. Right, I think you can see, I think I put it somewhere here. So buildings, when it comes to manufacturing buildings, we normally have a deduction of 5% for manufacturing buildings. Then we've got commercial buildings. They are also entitled to a 5% building allowance. They are also entitled to 5% building allowance. But administration buildings normally are not granted an allowance. Admin buildings are not normally granted an allowance. Right, so we have our proceeds. Our proceeds will be 1,047,000. And then our cost will be 890. So we'd say $1,047,000. Then our base cost $890. Then capital gain. Then only 80% will be included in your income tax. What do you get?
$125,600.
Right. Any questions there? Or did they say ignore capital gain? Oh, I see that here they said we should ignore the capital gain. Okay, so let me just include it here. Right, let me just say, for the sake of practice, I'll put it here so that I answer the question as it is. Then I'll just say, right. Any questions? Yes, lady, if it was a manufacturing building, would calculate the 5% per year, and there was also going to be recoupment. So there will be 5% deduction for the current year, and the 5% from 2015 will constitute also a recoupment. Right. So then we are done with that part. Can we please go back to our original information? Then we have a restraint of trade. A restraint of trade of 815. Right. Generally, we know that a restraint of trade right, deductible if it constitutes income in the hands of the beneficiary. Right. Deduction is the lesser of amount divided by years of restraint, or amount divided by 3. So you have to find the lesser of these two. So you have to go and check is the amount to be included in the income of the beneficiary. Actually, if they don't say it, our assumption in our exams is that it will constitute income, if nothing is said about that part. Then you also have to know the years of the restraint. Right, our restraint is 815. And when we go on number 3, we are told that Ricky Marino, an employee who resigned during the year, was paid an amount. There are amounts that SARS might say they can be they are not taxable in the hands of the beneficiary. So we don't normally deal with those ones in this module. So there will be circumstances that SARS might, the amount may qualify for not being taxed in the hands of the taxpayer. For example, if you are paying to a non-resident for services that are not done in South Africa, that's an example, just an example. That will not be taxable. Right, Ricky Marino, an employee who resigned during the year, was paid an amount of 815 on 1 November. The agreement stipulated that Ricky was unable to work for any of our Alpina's competition for a period of 3 years. The 815,000 was included in Robert's taxable income. So that condition is met since they specified. I think they just made the mistake when they say Robert, they wanted to talk about Ricky. Either the mistake is Ricky or the mistake is Robert. Right, so it's included in the taxable income. So it can be deductible. Right, now, it is stipulated that the restraint will be for a period of what? For a period of 3 years. So it's 3 years. Right, so would say right, we're going to say restraint of trade. So it's say $815,000 divided by 3. So if it's 3 years, so there's no other option. It's just 3 years. 271667. Right, and you should note that the deduction is not apportioned. The deduction is not apportioned. So my friends, even though the restraint was from 1 November, remember our year is ending in March. So there's only 4 months for the current year. We don't apportion. We don't apportion. Right. Then we go back. Purchase of a patent, 18,500. Right. We should know that a patent, it's 10%. It's sorry, patent, it's 5%. Invention or copyright, the deduction is 5% per annum. Right, if it's a design, it's 10% per annum. Trademark, no deduction. So you have to check the intangible asset that they are talking about. Is it a patent, invention, copyright, design, or trademark? In this case, it's a patent. So that patent, it will qualify for a 5% deduction. What do we get? $925. And you should note that this one is not apportioned. Again. Right. But we should know that if the amount is small, then it will be fully deductible in the first year. It will then be fully deductible within the first year. Right. So an amount all right. Sorry, just a second. So an amount is fully deductible if the expenditure so you will get a full deduction in that case. But if it is more, then you'd have to check, is it a patent, invention, or copyright, for you to know the deduction that will be made. Right.
Eugene.
Yes.
Yeah, let's say I have this pertinent for the next 3 years. Am I gonna reduce it to the 5% for every year?
5% for 20 years, boss.
Okay.
So if it's 5%, it's for 20 years. If it's 10%, it's for 10 years.
Okay.
Every year. So that 925 will be every year for 20 years. Right. Section 11A deductions. Right. So they're saying these are other deductions that qualify for deduction under Section 11A. We don't know what they are, but they are just saying these are many things that are that means they are satisfied that they are deductible. Right. Then donation made. Right. A donation is actually your last item. You right. The deduction is limited to the lower of 10% of taxable income before deduction. or actual donation. Provided a Section 18A certificate is obtained by year end. So if there is no Section 18A certificate, then the donation will not be deductible. But if it's there again, in the current year, you can only deduct up to 10% of the taxable income before the donation. So that means, first of all, before we determine the amount to be deducted, we first have to find our taxable income before the donation. So first of all, you have to find your taxable income before such donation. Right, so we have our sum here. We add everything here. That's our taxable income before the donation. Right, then we'll now have our donation. Limited to the lower of donation, which is 62,000. And 10% of 2,425,632. Which is 242,563. Therefore, fully deductible. So we'll subtract the full 62,000. Right. If this amount was, let's say, 50,000, we're only going to deduct 50,000. But the other 12,000 could still be deducted in the next year. So any donations which are not claimed in the current year can still be claimed in future years. Right. So then we get our taxable income. Income tax payable. Remember that small business corporations, they've got their special tables. They've got their special tables, which are different. If it's a company, it was going to be 27% straight. But for a small business corporation, it's different. Mokwena.
Eugene, do we ignore the provisional tax payment paid?
We're going to take it into account. First, you have to find the tax. Then you subtract what has already been paid to determine the tax liability.
Okay.
So we're still going to take it into account. So before you take into account the provisional tax paid, you first have to calculate the tax obligation. Right. Now, in this case, it will be 50. Eight 013. No, let me just verify this one. because the tables that I'm using. Okay, this one I'm using, I'll verify the ones that we'll be using, but I think they will be given there. We are normally given the tables for that, because this one is the one for 2023. I'm not very sure if we'll be using the one for 2024 because there's a difference there. Can we just use this one? What do we get? What do you get? Five six five. I get 830. I get 603.
830.
Is that
565830.
right? If you for the 2024 one, it's actually 57698 plus. I don't worry about this one because they always give you the text tables that you're supposed to use for this part. That is the 2024. Right. Then you subtract your provisional tax paid. The 58 is from the tax table. That 58 is from the tax table. You get it from the tax table. And tax tables are given. Right, provisional tax 652. Then we'll have our income tax refundable. They paid more. Provisional tax, it's normally the government, for it to carry out its activities, they need tax. And companies, they pay a large proportion of the tax. Now you would find that companies will only be sure of their actual tax at the end of the year. But the government needs to do activities during the year. So they can't wait for the end of the year. So some taxpayers are required to make what we call provisional tax payments. The first one, six months into the year, and the last one at the end of the year. All right. Any questions? Right. So that's it on this one. Right. I want to quickly do question 2, unless if you have any questions. All right. I want to quickly do number 2. Right. So after I do number 2, I would ask you to do homework question 3 and question 4. Then by Wednesday, can any of you please remind me in the group to send the solution? And please, it's to your advantage to do them. So please do them. Then by Wednesday morning, ask me for the feedback. Then I give you the feedback. You check your work. Then when we meet on Saturday, if there are any questions, we deal with them. All right. Hot Choc Private Limited is a coffee shop that specializes in making hot chocolate. Hot Choc is a March year-end required. Discuss whether Hot Choc Limited can deduct the 25,000 medical costs paid to the customer in terms of the general deduction formula, section 11A, read with section 23 during the 2022 year of assessment. Right, the section 23 deals with the prohibited expenditure. The section 23 deals with prohibited expenditure. Right. Now there are things that we have to test for us to see if an amount is deductible. Right. Right. Right, for you to know whether an amount is taxable or deductible, you have to know your definitions, the various components of the definition. Then you can be able to conclude whether an amount is taxable or not. I'm going to section 23. I'll be dealing with it in this question. So we're going to deal with it in this particular question. Of course, I'm not going to do it in detail, but I'm going to talk about what it says actually, so that you can be able to have right. When we are defining an amount for it to be deducted, a trade must be carried on. Right, there should be a trade being carried on. And in this particular case, we have Hot Choc is carrying on a trade of making and selling hot chocolate. Right. So that means they can be able to claim business deductions since they are carrying on a trade. Right. Then let's read this one was general. That's why I didn't have to read. I'd already read that they're carrying on a trade. Then we are told that on 22 April 2020, one of the, remember that it's the 2022 year of assessment that we're dealing with. And our year is ending in March. That means our year started in April 2021. Right. So on 22 April 2022, which was not the current year, one of the waiters fell over an object in the restaurant. It was in the previous year, and dropped a tray with a cup of hot chocolate on one of the customers. The customer suffered serious burn wounds and claimed medical costs of 25,000 from Hot Choc. Hot Choc did not want to pay the medical costs, and the customer approached the small claims court. On 10 March 2022, in the current year now, the court ruled that Hotchok should pay the medical costs of the customer. Hotchok paid the amount of 25,000 on 15 April 2022. So there's an issue here that this story is covering 3 years. Number one, the event happened in the year 2021. The court settled the matter in the current year, 2022. The payment was made in 2023. So now here is this amount deductible in 2022. That's our issue there. Right. So now we go to the definition again. In the production of income. Right. And according to case law, right, for an expenditure to be incurred in the production of income, it should be incurred in activities that are closely connected to the income earning operations. The business. That's what, right? Sometimes they insist that you should do include case law. Sometimes they say exclude case law. So if they are silent, it will rather be better to substantiate your arguments with case law. Right. I think I'm going to give you a document. I think during the week, I will make sure that also remind me to give you a document that has got some of these case laws, just on case laws only. Right. So now the customer suffered pains during the income earning operations is the waiter fell while serving hot chocolate. Right. So this accident happened within the income earning operations of a hot chocolate. So it was in the production of income. Right. Mind you, for an amount to be deductible, it should meet all the requirements. Right. Expenditure or loss. There is a loss or expenditure as the company would have compensate to the customer. Right. That compensation to the customer is a loss because there will be a payment there that will be made. Right. Right. Then it should be actually incurred. Right. In 2020, the amount was conditional as it depended on whether the customer won the case or not. Right. An amount is not deductible if it is conditional. Edgar Stores versus CIR 50. So it can only be deductible if it's not conditional. Right. Then we know that on 10 March Sorry, guys. I had been booted out since you saw that I just went out for some time. Okay. Right. I was saying when I was booted out, I was saying that when the court decides, then there is no what? It's no longer conditional. It's no longer conditional. Hence on this date, the customer was now entitled and unconditionally entitled to the amount more right. Although payment was only made in the 2023 year, the expenditure was accrued in 2022 when the court case was finalized. So that is the only contentious issue that was mainly there in this question. So we're saying number one, this happening, everything happened in 2022. Right, that is financial accounting say in 2021, they would recognize a contingent liability. That is according to the advice that they are given by their legal advisors. Actually, if their advisors tell them that they are likely to win, they will not even recognize the contingent liability. If they tell them that the chances are remote, but that is for FAC. Tax, they don't recognize it until it's finalized. For tax purposes, it will only be recognized when it's finalized. Right. During the year of assessment, right, although the causal event took place in 2021 financial year, tax year, the accrual arose in the year of assessment 2022 when judgment was passed. So it actually happened during the current year of assessment. Not of a capital nature. There is no enduring benefit. Arising from the expenditure. Hence, it's not of a capital nature. In this particular case, we don't have any enduring benefit. It's something that they are going to expend, and that's it. Right. Section 23, prohibition. I think which is one that our colleague was asking about. Right. There are expenditures that are not allowed in terms of section 23. For example, if you have a company and then you incur domestic expenditure using the company account, then that expenditure will not be allowed as a deduction. Some legal fees that are not related to the business, for example, if they are for the directors in their personal capacity that are paid by the company, they will not be allowed as a deduction. So it has got a lot of things that are not allowed as deductions. Donations that do not have certificates, they will not be allowed as a deduction. Enduring benefit, we mean, for example, if you buy a machine, you will benefit by using it to manufacture goods on and on and on and on. That's what we mean when we say enduring benefit. That means there's a benefit that will arise from that expenditure from the viewpoint of the company for a long time to come. That's what it means. So we're saying when we talk about section 23 prohibition, these are expenditures that are not allowed to be deducted. As I said, for example, domestic expenditure. Prepaid expenses that are more than 100,000 and which will only be for which the benefit will be for more than 6 months. So there's a whole list there. So in this case, there is no section 23 prohibition. Then I can conclude now. Since all the requirements are met, the expenditure will be deducted during the 2022 tax year. So if only one of these things that I was talking about above is not met, then the expenditure will not be deductible. For it to be deductible, it should meet all the requirements. So it's possible then, let's say a machine, you are buying a machine, like what my colleague was asking just now. You would find that there will be an enduring benefit here. Because when you buy a machine, you are expecting to use it for many years. The benefits will arise. That expenditure will cause benefits to arise to the entity for a long time. So that will be of a capital nature. So even if all the other requirements are met, it will fall. Yeah. Or maybe let's say, for example, you buy your groceries using your company bank card. It will meet all the requirements, but there will be a section 23 prohibition here. then it will not be deductible. So for an amount to be deductible, it should meet all these requirements that are there. If one fails, that amount will no longer be deductible. Any questions? All right, my friends, I give you question 3 and 4 as homework. Please, by Wednesday morning, I'm doing it deliberately. Wednesday, I want to give you days so that you can be able to do it. So I won't give you tomorrow. I'll give you on Wednesday. So please, Wednesday morning, can someone remind me? Then after remind me, then you check your work to see where you are wrong, gather your questions before we proceed. Next Saturday, then I will come with other questions other than number 3 and 4. Before we move on to number 3 and 4, you first have to raise your questions, then we can move forward. Thank you so much. God bless you richly and enjoy your day.